Hi guys, welcome back to the channel. In today's video I'm going to show you very quickly how to prepare a payroll journal. So I've had a lot of questions this week in particular, just how to go about preparing this, what goes on the debit side, what goes on the credit side and why. So a lot of the times I know in the study manuals that you have, or if you've ever seen a payroll journal before, it looks really scary and they don't really go into that amount of detail as to why things are a debit and a credit. You've just really got to learn how to prepare one. So I'm going to give you that background so that you don't worry anymore and you can see just how simple one of these payroll journals are to prepare. So we've been given this information down here, and the first thing I always start with when I'm preparing a journal for payroll is the gross salary. So down here we've got gross salary of £5,000 for our employees. So what we want to do is post that as a debit, so as a cost, into the P&L or the income statement. So if I just put PL/IS there, you can see. And the reason why that is a positive is because it's a cost. So it's a cost to the employer for the gross salary for that employee or employees. And we want that to go on the income statement to reduce our overall profit. Next, I would look at posting the employer's PRSI contribution. So that's just PAYE and pay-related social insurance. So again, that is a cost that needs to go into the P&L or the income statement. So that's £600. And then we move on to employer's pension. So if you think about employer's pension, two things need to happen. So we need to record the cost to the employer, and we also need to record the amount that's a liability to the pension provider. So say if you've got your pension with Nest or it's with Scottish Widows or somebody else, then we need to show it as a liability until it's been paid. So what we're going to do is we're going to debit here with £150 and we're going to credit pension in the balance sheet or statement of financial position. Just change that to capital. So that's all those three there. Now, other deductions, so you might have a case where employees have purchased holiday, for instance, so you can sometimes pay for that through your payslip, and you can say, I want to buy 5 holidays in the year. So what the employer will do is deduct that from your pay every month. So they'll spread that over the course of the year. So we've got a holiday that's been purchased here in this scenario, and that's going to be a credit because that there is a deduction from the employee. So it's not a cost to the employer, it's a deduction from the employee's payslip. So moving on, we want to work out the PAYE, so total tax that has been deducted. So that's this £1,000 here. So that again is on the balance sheet or statement of financial position as a credit. And the reason it's a credit is because it's an amount due to HMRC for PAYE, so pay as you earn tax. So that's going to be the employees and employers as well. So let's just box that off. Now, in this case, there are other taxes that need to be paid to HMRC, and that's going to be a credit again. And this is that £500 down there. And again, it's a credit because it's amounts owed to HMRC. And then we've got net wages. So net wages, again, is going to be a credit on the balance sheet or statement of financial position. And the reason for that is because it is an amount due to the employee. So it's a credit to wages until that amount has been paid by the employer to the employee. So it's going to sit on here in net wages until the payment is made. And once that payment is made, it's going to be a credit to the bank and a debit to net wages. So what you should see if you're somebody looking at a set of accounts is that every month that net wages total should go back to nil unless there is wages due to employees that hasn't yet been paid, which shouldn't really be the case because they'll be paid either monthly or weekly, so it should clear itself down weekly or monthly. Finally, we've got this pension of £400, so that is going to be the employees and the employer's pension contribution. So we've already put £150 up here for the employers. So what we need to do is £250 for the employees and the 150 for the employers. So again, the reason why that is a credit is because that's an amount due to the pension provider. So again, whether that be, I don't know, Scottish Widows or Nest or whoever, the employer is going to take that from the employee's payslip and pay that over with their own contributions in effect. So when they do, that's going to be a debit to pensions and a credit to the bank. And again, that's something, if you're working in practice or even industry, that you want to be making sure is being cleared monthly or whenever they do make contributions to their pension provider. So I'm going to keep this video short and sweet for you. But as always, if you found it useful or you like the video, then do give it a thumbs up. Consider subscribing as always, and I shall see you on the next video.